Here from the office today, doing the episode 2 of this financial independence retire early themed group here. And today we're going to probably talk about 3 or 4 different stocks, individual stocks. I had a subscriber asking about UPS, so we'll dig into UPS a little bit. And of course we have to talk about Nike. Nike has been volatile, it's fallen off a cliff. There's the tariff fears and China issues and all sorts of stuff to dig into with Nike, but I do actually like the company. I like the fundamentals. I like the balance sheet of Nike. A lot of cash on hand for that company, more cash than debt. So pretty tough for a company like that to actually go bankrupt. And then we've got PepsiCo as well to discuss. Big things happening with PepsiCo because of the RFK. Hey, what's up, Evencia? Nice. Tony in the house. I am great, man. Thank you so much, guys, for stopping in. Yeah, I'm doing really well. I had a fun weekend. It was Ava's birthday. We went to a cenote yesterday and then went and played, we did some bowling and played some games afterwards, so it was a lot of fun. What's up, Jay? Hey, everything is good, guys. Yeah, so guys, I wanted to kind of just discuss maybe 2 or 3 individual stocks, talk strategy, what you all are buying this week, or if you're thinking about investing in anything. And once again, guys, this is not financial advice. I'm not a licensed financial advisor. The goal is to start a discussion every week and motivate each other to reach these financial goals. I've got some espresso here, so cheers, guys. Let's dig in. Nice. Now, the goal was to do this at market opening every Monday, but because it was Ava's birthday, we were up pretty late last night. So I'm getting it better late than never here, 11:25 Eastern time. Hey, from Portland, Karen, what's up? My home city, Rip City in the house, Portland represent. Yeah, born and raised in Southwest Portland. So guys, getting right into it, and please do leave in the comments where you're watching from, any particular stocks that you want to discuss today, any strategies. And to be clear, guys, I don't own cryptocurrency. I've been getting that question a lot. Are you in crypto? Are you in crypto? And the answer for me is no, because I just don't know the intrinsic value of any given cryptocurrency. Whereas with a company with real cash flows, I can analyze and get a pretty good idea how much the company's worth on a per share basis. Toronto in the house, what's up, Anna? Good to see you. Dan, good to see you. From BC, from Canada. Nice, good group today. So any particular stocks you guys want to discuss, let me know. I want to start with Nike, and I want to let you guys know how I'm generating cash flow with the volatility of Nike. Now, this is not like a crash course on options trading, but I sold 2 cash secured puts on, multiple contracts, but 2 times on Nike this month. And because the volatility, the implied volatility was so high, I was getting paid a premium to sell these cash secured puts. So the first one I did at $55 and I got paid $2 per contract, which means the shares would have had to have fallen below 53 for me to be assigned those shares. And it expired worthless. I kept the $200, and then I redid that when Nike fell again, but I did this cash secured put at $54, and then Nike actually went up, and I got paid $1.30 per share on that contract. So that's cash in the pocket. Every contract is 100 shares, so that's $200 on one contract, $130 on one contract, cash flow off of options. But the reason I did those cash secured puts is not just to generate cash flow, it's that I wouldn't mind owning Nike stock at these levels. I think the risk is priced in. I'm doing great, Anna, thank you. I did have that taco on you. I also had some pancakes and yeah, a lot of food. So thank you, Anna, really appreciate that. Yeah, to keep the train of thought going, guys, Nike I think is a really high quality business. Obviously, these are household names that we're talking about today: PepsiCo, Starbucks, UPS, Nike, Google. we'll talk about Tesla too, I guess, because I know a lot of you guys are interested in Tesla. It's a hot topic for sure. Let's start out with Nike though. And what I want to mention first is obviously the risks, the tariffs, but I also want to keep you guys informed. From my perspective, the tariffs can be rescinded at any time. And I think the moment that President Trump pulls back on some of these tariffs, because China's making some pretty heavy demands on rescinding the tariffs, and this is in no means a full discussion on the whole tariff situation or political situation or anything else. Hey, Freddie from Vegas, what's up? But those tariffs can be pulled at any time, in which case stocks like Nike that have been beaten down will probably surge. And that's just my humble opinion, not financial advice. But I also want to point out the strength. The first thing I do is look at the quality of a business. Is it worth owning? Because it's one thing to get a good deal on a crummy stock or a crummy company. It's another thing to get a good deal on a high quality business. And so I want to talk about the balance sheet of Nike. And as I pull up on my screen here, the cash to long-term debt is sitting at about 11.5 billion. And I'll pull up Yahoo Finance just to have two different references. And Yahoo Finance, guys, you all have access to that. So I'm also using CFRA, which some of you may not have access to. So we'll pull up Yahoo Finance and go to Nike. And the first thing I want to do is look at the financials and then the balance sheet. And what I want to see is that there's plenty of cash, more cash than long-term debt on a company like this. Okay. And then I'll look up on CFRA as well. 11.5 billion cash to 8 billion in long-term debt. So it's basically a fortress balance sheet. I mean, Nike can literally not go bankrupt. They may have some issues with production, with factories in China. We don't know where that's going to go. There may be some issues with tariffs, but that checks that box right there. And then the other thing I want to look at is the share price is basically back at levels that it was 10 years ago. $57 a share at the time is, yes, absolutely. Zebulun market is down, good time to buy. So that's my sentiment as well. When there's blood in the water, even if the blood is your own, you want to buy. But what I'm looking at here is a huge disconnect with Nike because the revenue is up. In 2015, the revenue was 30.6 billion. As of 2024, fiscal 2024, revenue was at $51.3 billion. Net income went from 3.2 billion to 5.7 billion. So there's all this growth within the company, yet the shares are trading at levels they were in 2015. So the company's producing more free cash flow, 4.36 billion in free cash flow. In 2015, it was 2.16. So double the free cash flow, yet the same share price. Dan C, what's up? How do tariffs play into your strategy? Well, that's a great question. And that's why I'm talking about Nike. Is I want to find the highest quality business that's affected the most by the tariffs, so I can get a good deal on it and I can be a contrarian. What got me to retirement at 34 years old was being a contrarian and buying stocks that people were selling off. And so my philosophy with my thinking with the tariffs is that when the tariffs are rescinded, and they will be rescinded, they're not going to last forever, stocks that have been beaten down the most will recover, have the sharpest recovery. And that's probably an oversimplification, but that's my broad thinking. And then I have to dig into the actual company and see, hey, what's going to happen in the short term with the cash flows? Is the dividend safe? Nike does indeed pay a dividend close to 3% yield at these prices. And so that's the thing with tariffs. You can look at other companies like American Tower have done really well. American Tower is a real estate investment trust, and they're largely not going to be affected by tariffs, at least as far as I can see. What they do is they buy real estate, they build cell towers, and then they rent out space on the cell towers. I've owned American Tower twice. I currently have a pretty large position in American Tower. Both times I bought it, my entry point was in the low 180s, and then at both times I had a chance to average down and buy in the 170s, 160s, and even the 150s. As of today, it's trading around 210. So you can go one of two routes. You can buy the companies that are hated, that are struggling because of the tariffs, or you can try to buy companies that aren't affected, that are kind of tariff proof, and that would be like American Tower. So those are two examples. Nike heavily affected, at least the perception is that they're going to be heavily affected. The market is pricing in some big time problems with the tariffs for Nike, and then the market is pricing in the security of American Tower and driving the share price up. So we've got one company that's not affected by tariffs, share price going up, and one that's affected by tariffs, share price tanking. Which one would you buy? I'm taking Nike at this point. And I'm probably going to keep selling cash secured puts on that. No bond funds, Kevin, but great question. Thoughts on Ford from Freddie Lamelli. I haven't analyzed Ford in quite a while. I'm not big on automakers, manufacturers. I'm also not big on airlines. It's just a tough space, and the cash flows aren't always predictable. But I can pull up Ford here in a moment, take a look. Nvidia, good buy, and hold to sell once they come back to 150. Yeah, I mean, Nvidia under $100 is tempting. The growth is, hey, what's up, Jamie? The growth is there. The growth metrics are there for sure. And so Nvidia is a hot topic for sure. We'll pull up Nvidia here. Yeah, trading back at 106, down almost 4% today, so a lot of volatility. And let's see what Morningstar has a fair value estimate of $125 for Nvidia. And so there's a decent margin of safety, but you got to remember too, Nvidia is probably going to be affected by the heightened China restrictions as well. So this company is not immune to what's happening with the US and China at all. And so I think the market's pricing that in as well with Nvidia, and that's why the shares are trending down pretty sharply. Is it a long-term buy and hold? Probably a great buy, especially for an investor with a longer time frame. Once again, not financial advice, and I'm not personally buying Nvidia because I'm already retired and I want more dividends, I want more cash flow. But for someone who's maybe in their early to mid 20s or early 30s but doesn't want to retire for another 20 years, you know, buying Nvidia could make a lot of sense for that person's situation. It's good espresso, nom nom nom. All right. And so Ford, let's take a quick look at Ford. I want everybody to be heard today in the group, and so we'll take a quick look at it. One of the biggest problems I have with Ford is it's just traded sideways for so long. The equity hasn't really gone anywhere. And then, so if that's the case with a stock, I want to make sure that I'm getting a high dividend at least so I have some aggregate dividend income over the years to make it make sense to hold the stock. And with Ford, they've actually cut the dividend multiple times. The cash flows aren't very predictable. Could one maybe do a speculative allocation, 1 or 2% of the portfolio in Ford? Why not? I mean, you could. The stock's down 32.5% over the last 3 years. It's down 21.5% over the last year. And so it's a highly cyclical business. And but can you make some money on it? For sure. I mean, if you're buying these dips, let's see, where's it at over the last month? Pretty much sideways. The last 3 months, down 3%. Let's see if Morningstar has a fair value of $16 a share on Ford, and I think that could be a little bit high, but maybe they're pricing in some growth with the electric vehicles, the EV business. But that's a very competitive space, competing with Tesla and NIO and other companies. All right, guys, let's talk about UPS, another household name, cyclical company. Now, of all these companies that I've mentioned, the only company that I'm considering buying for my own portfolio right now is Nike. Aflac is often overlooked. Absolutely. Very good point there. Easy Street with Jen. Let's pull up Aflac. It's a premium quality company for sure. I remember during the global health crisis in 2020, Aflac was trading in the like $30 range. It's trading at $108 today. They are a dividend aristocrat. They grow the dividend every year, and they have for quite some time, well over 25 years, I believe. And so Aflac, yeah, great mention there. I think that one, you know, if you want some exposure to that space. Now, is it a buy at these levels? I don't think so. It's just there's been so much. Let's see the growth over the last 5 years. It's up 198%. But it's one of those companies you could put on your watch list for any kind of a pullback. And if you do see a pullback on Aflac, yeah, it's a company that you could nibble at. You could dollar cost average into. UPS is an interesting one because I have owned UPS before, but it was a short-term hold. I had a buddy who used to work for UPS for quite some time. And he told me, he's like, hey, this is what's going to happen with the stock after the holiday rush. And the stock really cooled off. I think I sold out in December. And let's pull that up. Yeah, I sold out somewhere in December around $128, and it's down trading at $97 and some change. But let's look at the quality of the business first. Let's look at the cash to debt. This is always where you want to start, guys. Quality first, valuation second. Make sure the company's good quality before you even consider doing a valuation workup and consider buying it. It's kind of like when you go buy a car. Just because you're getting a good deal on the car doesn't mean it's a good car. You want to make sure the car is good first. So cash to debt, 19 billion in long-term debt, 6.3 billion in cash. Not terrible. Not a bad balance sheet, really. Net income is growing. Revenue is at 91 billion, up from 58 billion in 2015. Free cash flow has been kind of lumpy and cyclical, which you expect with UPS. Sitting at 7.2 billion in free cash flow. And the company peaked in 2021, guys, during the health crisis. You can imagine how many people were ordering from home, 12.3 billion in free cash flow. So the shares went up following the free cash flow growth and the earnings growth, and then the shares cooled back down as free cash flow growth slowed and even reversed a little bit. So what are the big threats to UPS too? I mean, Amazon continues to scale and be able to deliver their own, fulfill their own orders. So, you know, there's some risk there, and then there's revolutionizing delivery. But I do think that UPS has the capital and the utilization of AI and the right people at the helm to probably stay on trend with this stuff. If people start delivering packages with drones, I'm pretty sure UPS is going to have a fleet of UPS drones doing that, robotics, whatever it may be. I know that some of those projects are being rolled out in big cities like Los Angeles, along with autonomous driving, driverless trucks, but I think UPS has the scale and distribution network that they have a moat. Their network is vast. So I wouldn't sleep on UPS. For me, it's a little bit cyclical to hold long term. If you look at the 5-year chart, it's basically flat though, which is kind of intriguing at this point. I think this is probably a decent entry point for someone who wants to own the stock. UPS, Morningstar has a fair value estimate of $130 for UPS. So pretty good margin of safety there. I usually like at least a 30% margin of safety on cyclical companies. So it checks that box. We've got one that I have been watching is Saya. They were 500 plus November. Now it's at 240. I'm not familiar with that company, Zebulun. Richard, a Chinese company, came out with a new AI chip that is possible competition for Nvidia's high-end AI chips. Yeah, that's one of the reasons I don't invest in the chip makers, is because the technology changes so quickly, and it's kind of a winner-takes-all game. And so for a long time, Intel was the clear winner, and then poof, all of a sudden they weren't. Cash flows got hurt. The company cut its dividend. The shares tanked. And I have owned Intel. I ended up I didn't take a loss on it. I had to hold it. I had to bag hold on it for a while. Then I sold out, basically broke even. But once they cut the dividend, it was completely worthless. It was dead money. And so Nvidia, that's a really, really good point, Richard, is that if all of a sudden there's a South Korean company or a Chinese company or whatever company that comes out with a slightly better chip, Nvidia's cash flows will be hurt pretty badly. And so, but with consumer staples and things like that, those are supposed to be safe haven stocks, and those haven't exactly done very well recently because of the Robert Kennedy, getting rid of the artificial dyes in foods and stuff. Companies like General Mills, PepsiCo, Campbell's, they're going to have to make some serious changes. And I do think, once again, PepsiCo will be the most well-positioned to handle that because of their scale and the just the mass of the market cap of the company, the amount of resources that PepsiCo has versus, say, Campbell's. Campbell's a fantastic company as well as far as their brand portfolio. And then I think it's also important to remember on PepsiCo, not to shift too much away from UPS here, but I think it's important to remember that this is a global company. They're selling their products in Mexico. They're selling their products in Southeast Asia. And so the Robert Kennedy thing and the GP1, the drugs, the weight loss drugs, will largely affect the US markets. But I also think PepsiCo is shifting and buying more health forward brands. They bought a prebiotic soda company. So you have to remember, companies like PepsiCo can make acquisitions to stay on trend because they have the cash. So, but I'm not sure who it was who asked about UPS. I'm hoping that you're here in the chat. Let us know. If not, we'll move on from UPS. And hopefully you can watch this later. This will be public. This will be uploaded and published for you guys to come back and watch later. Who those of you who couldn't make it to the live. What's up, Adam? How you doing, man? Good to hear from you. Met a woman in Mexico City, got her number, and stay in touch. She works for UPS. UPS is big in Mexico. Yeah, absolutely. Good point. You see UPS all over Mexico City. Distribution centers, trucks. DHL is obviously probably their biggest competitor in Mexico. Let's see, Duncan, we got, if you want to hedge your long-term holdings during a bear market, buy SQQQ, which is a 3x leverage ETF that goes up with QQQ. The QQQ goes down. Okay, yeah, that's an interesting way to hedge for sure. I mean, there's some interesting ETFs out there too, like JEPI, JEPQ. We talked about those in episode number 1, and those are more like covered call ETFs that yield 11% as far as the distribution. Now, those are not qualified dividends. You will be taxed differently on those funds. JEPQ, JEPI is the one we were really talking about. That JEPI is definitely a covered call ETF. JEPQ, I can't remember. I get them mixed up a little bit. But JEPI is one that you'll have to deal with the tax situation on that. But yeah, it yields 11%. So there's a number of those 3x ETFs don't hold up long term. Adam, that's a good point. I could argue the same, that a lot of time the issues with those leveraged ETFs is that equity itself trends down. So no matter how much the dividend or distribution is, over the long term, your equity is losing value. And so it's kind of a losing game, in my opinion, unless you just want kind of an annuity proxy or a bond proxy. But I think there's better ways to do that, like maybe buying utility stocks like Duke Energy with a margin of safety. Then you can get that 4.5–5% yield, which is kind of a bond-like yield. But over the long term, Duke Energy or Southern Company, two of my favorite utility companies, trend up. And so if you're planning on holding the company for 10 or 20 years, you can rest easy knowing that your equity is going to be worth quite a bit more than when you originally entered the position. Micro Money Mastery says, what are your thoughts on VU, Vanguard Index Funds, S&P, ETF, USD? I think they're a great option. I think all of the Vanguard products are fantastic. I'm not associated or affiliated with VYM or Vanguard or any I should say Vanguard. But VYM is a fantastic dividend fund from Vanguard that I think is a nice place to park some cash, and it instantly gives you some diversification. And the top 10 holdings of that fund are fantastic as well. So another one that I really like is SCHD. And so I'm actually, just out of curiosity, I'm going to pull up the top 10 holdings of VYM, which is a high dividend yield ETF from Vanguard. And I like that you guys are bringing up the subject of ETFs, because not all of us are going to be able to analyze single individual companies and be confident enough in our entry point. So VYM, the top 10 holdings are Broadcom, JP Morgan, ExxonMobil, United Health, Procter & Gamble, Johnson & Johnson, Walmart, AbbVie, Home Depot, and Coca-Cola. And then you've got names like Bank of America, Chevron, Philip Morris, Cisco Systems, Wells Fargo, so on and so forth. Merck is also in the top 20, as is PepsiCo. So you're getting a really nice fund there. Even Starbucks is down the list at number 46. So yeah, I like the Vanguard ETFs. VOO, yeah, I mean, I think people do really well with it long term. I mean, the S&P at one point was up 52% over a two-year period. So if you own VOO, you're getting that, you're mirroring the returns of the S&P. Let's see, Adam. Slippage and fee loss. Yeah, that's a good point on the fees too. You always want to look, very good point, Adam. You always want to look at the expense ratio on an ETF. Charles Schwab charges 11% for margin, don't buy dividend ETF. Yeah, I mean, trading on margin in general is super risky business. I did not know the number was at 11% for Schwab. Used to buy them on margin all day, but those days are over. Yeah, definitely a lot of risk there with that. And that 11%, it's really hard to make that make sense. That's really going to eat into any potential gains. Now, I can see why people get tempted when the S&P is up 25%. You think, okay, 11%, trade on margin, but the S&P is not going to average 25 or 26% returns. It's going to revert to the mean, and which means we could have some negative years, we could have some flat years, and then as Warren Buffett says, when the tide goes out, you can see who's been swimming naked. And trading on margin is kind of like swimming naked, expecting the tide to never go out. Years ago, I used to do most of my trading on margin. It was my best friend. Yeah, that's interesting, Adam. I mean, it can be done. It can be done right. In the best of times, it tends to work out pretty well. And so, guys, I want to circle back to Nike. I really think it's a high-quality business. The margins are very wide for for a company of in that sector. Close to 10% net margins, which is fantastic. So even if the margins get squeezed a little bit, I think Nike's probably going to do just fine. Fair value estimate from Morningstar is $112 on the dot per share. I think they're a little bit high on that estimate. I came up with a fair value of about 98 recently, but it's trading at 57, 58, 56. It's been as low as like 52, 53 a share. So, and this headline here from Morningstar on Nike. It says, apparel industry, tariffs are potentially disastrous, but could be rescinded at any time. And I echoed that sentiment at the very beginning of this live stream today, guys, is that those tariffs are not permanent. They can be rescinded it's like a light switch. They can be turned off, they can be turned on. I think a lot of what's going on right now is just posturing, between the US and China, and there's a little bit of kind of megalomaniac stuff going on potentially. Someone trying to kind of flex. But eventually when that no longer makes financial sense for the countries involved, those tariffs will be rescinded. Yeah, I mean, the risks are very real, but then those risks are being priced in. We're seeing, I sold those cash secured puts at 55 and 54 on Nike, and that worked out pretty well because I truly had conviction that was the bottom. I don't know long term if that's the bottom or not, but it felt like it. It felt like the stock was getting a lot of support there at those levels. And I think institutions are buying the stock. One tool that I like to use is a website called Insider Screener. And there's quite a bit of free data over there. You don't have to pay for it to get at least some data. And then we'll type in the ticker symbol, and we'll see if insiders are buying or selling. Insider selling is not really a red flag for me, but insider buying is something that I look at. I look at that as a huge positive. And it looks like, there's not a ton of buying or selling going on. There's, one big buy and one big sell. The last big insider sale was $8 million worth of shares at $72.80 a share. So the stock is $15 a share cheaper than it was then. So even if the fair value kind of keeps trending down due to tariff issues, you've got such a big margin of safety with Nike that I think it's a tempting. There's a good thesis, a strong thesis for investing in that. You should have talked to me after volleyball, Rope brother. Hi from Berlin. Hey, what's up? He was bashing the hell out of Adobe Film Suite, and he switched out of this. I took note of that. He was 110 million subs, could rock the stock down a bit. Interesting, yeah. I mean, any channel that has 110 million subs is probably going to have some type of material effect. Hey, what's up, Mark? Good to see you, man. Yeah, no, I would have loved to have sat down for coffee, because actually, Mark, I'm glad you're here. I want to welcome you. Mark's a good buddy, volleyball friend of mine. Are you back in Playa? If so, let's sit down and have coffee. If you're in Germany, thanks for joining here. Mark and I discussed Nike, not in great detail, but at the gym. We were both at Evolve lifting some weights and having a casual discussion about Nike. And I remember, I think, Mark, you were selling cash secured puts on Nike, and then the shares didn't get assigned. The stock price went back up to the low 80s, and I think you were kind of bummed that you didn't get the shares. But I'd be interested to hear your thoughts now that the share price has come back down into the 50s. Okay, so you're meeting investors in Germany. Interesting. Yeah, no, I'd love to hear your thoughts on Nike. I think fundamentally it's the same business that it was 3 or 4 months ago. I think the tariff fears are priced in. That's just my opinion, not financial advice. But would I be comfortable owning Nike? Would I sleep well at night? Yeah, I think so. And that's why I've been selling the cash secured puts. I won't generally sell puts on anything that I don't want to own. That way it's a win-win. If I don't get the shares assigned, I at least get that premium for selling the put options. And if the shares are assigned to me and it's a high quality business, I get the premium from selling those options, but also I end up with the shares. So it's really not. Now, if it's a trash company and I sell a put and I don't want to be assigned the shares, that would be a fairly irresponsible way to use cash secured puts. Thank you, Mark. Appreciate that. He says that's correct. Nike's great. You were spot on. Yeah, I think the balance sheet is fantastic. I think the revenue growth, the cash flow growth, it's all there. And so right now it's just more sentiment and fear with the tariffs. Would you mind sharing, Mark, a couple of the better opportunities in the markets at the moment? You say there are a few better opportunities in the market. I'd love to hear which companies or ETFs or funds that you're talking about. And I'd love to get your thoughts too on PepsiCo and some of these consumer staple stocks. PepsiCo, Campbell's, they've been beat down. But that's the point of this live stream, guys, is that we start a discussion, we share our opinions, and share what we're buying or what we think looks like the most attractive stock at any given time. I was a big buyer of Huntington Ingalls, ticker HII. They are a shipbuilder. They build nuclear subs. I thought that was really attractive in the 180s, and it trended all the way down to the low 160s, and even I think touched the 159, and I bought more. That's no longer in my buy range. It's at 227 a share. So I've got nice gains on Huntington Ingalls. They build aircraft carriers, nuclear subs. I think it's a great company. And Trump came out and the company lowered guidance, and then Trump came out and said, hey, we want to build more ships. We're going to need more subs. And it's like, oh, shocking. With all the tensions in China, we're going to need maybe more nuclear subs and aircraft carriers in the South China Sea. Let's see, Dr. D. Sunny, thoughts on APD? One in addition to Nike and Pep. Well, sell puts and calls on Spike and VIX. PepsiCo's a little too big of a market cap. I'm more interested in growth. Very good point there, Mark. Especially with the market tumbling, yeah. No, I can see your point there. The growth is slowing, but I think that 4% starting dividend yield kind of helps offset the lack of growth there. You're at least getting that nice 4% yield. I'll pull up APD. I'm a big fan of Air Products and Chemicals, guys. I think it's a very moaty company, a very moaty business. And Morningstar agrees. They've got a wide moat rating. Trading at 266. I mean, I think it's a really good long-term, probably a really good long-term investment. It is cyclical, and so Morningstar has a fair value of $333, and it has recently traded up toward those levels and pulled back to 260. I think it's a fantastic company, and the end products are used in so many different markets, whether it's healthcare, food and beverage, and on and on. These gases that they produce and sell have a lot of different applications. So APD, top-notch company. I haven't checked in on the company in a while, so I really appreciate you mentioning that, Dr. D. Sunny. I think APD's a fantastic company. And then if we look at valuation here, forward earnings of 14.19. And it's never the cheapest stock because it's a very high quality business. But if we take the price of 266, divide that by forward earnings of 14.19, 0.9, forward earnings guidance. Gives us a forward price to earnings of 17.85 on APD. 17.85, and then we'll go down here and compare that. I'll show you guys on my screen what I'm talking about. We'll go down here and compare to the 10-year lows. We can see 17, 19, 20. This is where we're looking right here, guys. 20, 27, 23. So historically speaking, we don't really see air products and chemicals trading that cheap. So I think it's probably a pretty decent entry point to answer your question, Dr. D. Sunny. Hopefully that does answer your question. Yeah, no, it's a great company. It flies under the radar because it's kind of a boring business, but boring is good sometimes. You know, there's some growth there for sure. The company it's easy to understand what they do. And sometimes not having a lot of mystery surrounding the companies that you're owning or considering owning is a blessing for sure. Preparing a list. Okay, Mark says that he's quality with high growth will be available soon. I've been preparing a list of 20 companies in the last decade we should talk about. Excellent. I would love to. Maybe next Monday in the episode 3 of the live, we can do that. Maybe discuss at least 2 or 3 of those companies on your list. And I myself, now that I have this YouTube channel and it's monetized, I'm focusing a little bit more on growth as well. I'm less and less reliant on dividends and cash flow from the stocks. So recently I've been buying Google. No mystery there. I think that Google trading under 150 was a steal, trading at 14.8 times forward earnings, something like that. Anytime you can get Google under a 15 price to earnings, to me that's a win. I plan on holding the shares for 20 years, so I'm not too concerned with any short-term volatility. So Google's kind of my growth go-to, but also they pay a dividend now. It's a small dividend, and I think they'll grow the dividend over time as the company continues to mature. Let's see, anything else, guys? Questions? What are you guys, like personal wins in life? Feel free to share anything. Companies that are calling out to you that you're considering investing in. I'd be happy to do a quick fundamental analysis, share the Morningstar reports for those of you who don't have access to Morningstar or CFRA. So guys, definitely use this time, these last 7 or 8 minutes, we'll call it, to ask any questions about any specific companies or funds, and I'd be happy to give you my quick, rough and dirty fundamental analysis as a fellow retail investor, not as a licensed financial advisor, not financial advice, but I'm always happy to help how I can. Tesla, no, Jonah, I don't do crypto. I don't. I just don't know what it's worth. To me, there's no intrinsic value. It's only worth what the next person will pay for it. It doesn't mean you can't make a lot of money in cryptocurrencies. People make a living out of it. People retire on it. It's not for me personally, but I don't fault anyone who's utilizing cryptocurrencies and trading cryptos on a regular basis. It does work pretty well for some people, not everyone though. Jonah, I've done well on crypto, throw a few dollars here and there. Yeah, I think guys, the important lesson here is investing in what you understand. And if you understand crypto and you're comfortable with it, and you understand the risk reward, that's your choice. You can do that. Me personally, I like cash flowing businesses that pay dividends. That's what got me here, and I'm not going to stray away from my strategy at this point. Adam says I got started in crypto in 2013. Bitcoin was $1,000. It's near 100,000 now. Yeah, absolutely. I still don't know what its intrinsic value is, but I know there's such a steadfast community of believers in Bitcoin that it seems like it's here to stay. And certainly anyone who got into Bitcoin early is probably doing cartwheels to the bank as we speak. Gold and silver, I don't own physical metals. I have owned gold, miners, but once again, gold is not really a productive asset. I like productive assets, and by that I mean that there's some cash flow, that there's a business, right? Metal's metal, it just sits there, it doesn't do anything. There is intrinsic value, at least with gold, but I need cash flow, and that's how I pay my bills, is cash flow from these companies that then share their cash flows in the form of a distribution or a dividend, and the cash flows are growing at a rate where they can raise my dividend, which is like a free pay raise of 6, 7, 9, sometimes 12%, depending on the company and how well they're doing. And that way I can keep up with inflation over the years and the coming decades. I plan on hopefully living at least another 50 or 60 years, and so I need to outpace inflation, and that's why the dividends are so important. But more importantly, the dividend growth rate is very important. And I don't get that off of something like gold necessarily. I think there are some gold miners that do pay small dividends. Barrick Gold, I think, pays a decent one. Let me pull that up here real quick. So I don't think it's a bad idea. I think any good licensed financial advisor would probably tell you, hey, you could allocate 1% or you could allocate 3% to gold. And Barrick Gold, the ticker symbol is GOLD. And you can see it's down 30% on the 5-year chart, down 13.8, call it 14% on the 3-year chart. There's really no moat because they're just a gold miner. So anyone with a decent amount of startup capital can start mining gold. Morningstar has a fair value of $23.50, is trading right around $20. So really no margin of safety on Barrick Gold. And they do pay a dividend, but it's yielding about 2.1%. So Nike, for example, is yielding close to 3%, PepsiCo yielding around 4%. And so you can certainly get better yield and more growth. So no crypto and no metals for the Rope Monster. It's just not how I do it. Adam says, if my divorce is complete this year, I'm planning on coming down to PDC for 1 or 2 months every year. Good for you. That's a great goal right there. I'm really happy to hear that, Adam, that you've got a plan, something to look forward to, and you'll always be a welcome part of the community here, my friend. It was so good seeing you at Pizza Renzo and finally meeting you in person. Have I been to El Salvador? No, but I'm actually thinking about planning a trip there. Jonah says, hit me up with your top dividend stocks. Some of my favorites, and some of these may be controversial, of course, but PepsiCo, Merck, Starbucks, US Bank Corp has been a really good one for me. I don't currently hold US Bank, but I think it's a very, very strong regional, the 5th largest bank in the US. Nice yield, trading at a decent valuation right now. I was buying US Bank Corp when the regional banks were selling off, and once again, being a contrarian. So Silicon Valley Bank went bankrupt. There was a big run on the bank, and then all the other regionals sold off, and I actually looked, like I usually do, for the best quality company in that sector and did my analysis and started buying it. And so to me, US Bank Corp was the best quality regional bank, and I did very well on that. My entry point was around $33. I bought it all the way down to $27, and I started selling out of it in the $46, $48, $49 range, just about 18 months after I entered. So long-term gains of about 60% on US Bank, but all the while I was collecting that juicy dividend. Well, Stacy, let's not call it financial advice. I'm just here to help and share my journey and my strategy. And I am super, super happy to have you here, Stacy. I always enjoy your comments. You're a hoot. So yes, muscles and a little bit of brains. Some brains and some brawn. I don't day trade, Jonah. I'm pretty much long-term in these companies, and by long-term, I define that as at least 12 months. Mostly for tax reasons. I like to buy a company and hold it for at least 12 months, collect the dividend meanwhile, and if and when it reverts to fair value, I'll generally start taking some gains and selling out of the stock if there's something else I can put that capital into. Yeah, the best fund you ever owned, Howard. Thanks for sharing that. He says a dividend fund. And it doesn't surprise me because the aggregate dividend income, if the equity is also going up and you have those quarterly distributions, that cash adds up over time. I've got Bank of Nova Scotia I've owned for quite some time, and it's a lackluster stock as far as just overall equity growth, but the aggregate dividend income over the years has been insane with Bank of Nova Scotia because it's just a cash flow machine. It's a cash cow. So thanks for sharing that, Howard. Muscles and Money channel. Yeah, that would be a good, if I wanted to start a second channel and just focus on the finance stuff. I actually used to have a channel called I Did It for the Dividend, and it just, I don't like to be so linear and focused on one area. Like anyone, I get bored, and so it's a lot of fun for me to do this on Mondays. And then it's a lot of fun for me to put it away and go do beach walks and food and Playa del Carmen content, Mexico City content. So, but I am really enjoying doing this at least once a week. Howard, you just kept rolling the dividends back in. Yeah, he just kept rolling. Yeah, if you keep reinvesting those dividends, you build this snowball that's unstoppable. Yes, I have held quite a few stocks for more than 1 year. Usually my holding period is more like 18 to 30 months. CVS was one that I held for quite a while. I thought the cash flows were very strong. CVS, once again, controversial in the health insurance space, the retail pharmacy space. Obviously, Walgreens was the crummy company in that sector, and I thought CVS was the clear winner in that retail pharmacy and health insurer space. So they underbid on some of their severely underbid, right, on their insurance. I can't think. I need more coffee. But basically, CVS was hurt for quite a while. It tanked, and I averaged down. My cost basis is like $53 on CVS, but I held it. I've held it for almost 2 years, almost 24 months, and I started taking gains when it was up at $68 to $70 a share. It's actually the top performing stock in the S&P for the year because it traded all the way down to like $42, $43 a share in December, and CVS proceeded to gain 60% up to the upper 60s. So CVS is one that I've held. Longer term, I've held Campbell's. Let's see, what else? Starbucks, I've held for 1.5 years, 2 different times. Raytheon Tech, American Tower, I've owned those companies for 2 to 3 year periods. And don't judge me on this one too, guys, but like Philip Morris International, I own that. Realty Income, I've held for 5 years, ticker symbol O. That pays a monthly distribution. It's a real estate investment trust, and I see no reason to sell Realty Income. It just pays me every month, and I can use that to pay my bills. And if someday I see it as severely overvalued, I'll sell it and take some gains. Hopefully that answers your questions. Yeah, crypto is very volatile. Why I don't hold crypto? Christine, that's a fantastic question. Thank you for asking that. I can only invest in something that I know the intrinsic value of. And so with crypto, I really don't know what it's worth. Whereas I can do a discounted cash flow or a discounted dividend model and then do relative valuations on companies like, say, Chevron or PepsiCo or Starbucks. And within a few dollars, I can figure out about what the company's worth per share and then just make sure I'm paying substantially less than what it's worth. And in that way, I'm getting a dividend, and then when it reverts to fair value, I have some pretty substantial gains on these boring, predictable companies. Crypto, I just truly don't know what it's worth. I have no idea there's no workup, there's no formula necessarily that I know of. Maybe you guys do. but I don't know what it's worth, and that's why, Christine, that's why I don't own crypto, and also just lack of cash flow. I need cash flow. I like dividends and distributions. Hey, what's up, Mike? Did you walk out of open heart surgery to be here, buddy? That was, I'll always remember that comment. I think that was you, Mike Morgan. He says, if I got the notification that the Rope Monster was live, I would walk out of open heart surgery. Let's see. Yeah, it's just very volatile, no doubt. Jonah, so do you lump sum? I usually dollar cost average. I go into a company usually in like 3 or 4 different tranches, if not more. Back when I was still working, I would dollar cost average in over the course of months or even a year or so on companies. And so I would buy 1 share here, 10 shares there, 100 shares here, 5 shares there, whatever I could. I remember when I was first buying PepsiCo, humble beginnings, I was buying, 5 shares of PepsiCo at a time, and over time that adds up and you end up with the average of all of your tranches as your cost basis. So, yeah, my pleasure, Christine. That's what it's all about here, is transparency. It's about sharing anything that will help the whole community. We all want to be better investors. Most of us who are here in the group, want to retire early. And I will say it's pretty sweet to be retired in my 30s. I still put in work. I still have to stay busy with something, and that's why I'm doing the YouTube channel. But I also want the clear message to come through that it can be done with a little bit of hard work and sacrifice, and of course reading the right books and educating yourself as best as you can. I will leave you guys 2 book recommendations, as I will continue to do on these live streams. One I mentioned in the last episode, Pat Dorsey, 5 Rules for Successful Stock Investing. That's a fantastic book. The other one is Peter Lynch, One Up on Wall Street. I think it's a great book. And that one might resonate really well. But I think if you can only read one book, it's the Pat Dorsey. Pat Dorsey's the founder of Morningstar, and he's an investor whose strategy really resonates with me. And so I would recommend that book. Nearing retirement, Jonah says, have 100K still in a money market. I can't suggest where you put that. That would be kind of like financial advice. I can tell you what I would do, and what I have done is I would pick probably maybe 3 ETFs, 1 or 2 ETFs, and then maybe 7 or 8 individual stocks that are high quality businesses that pay dividends, that have strong balance sheets, and then I would average into those positions over time. I think that's the most prudent way, especially when markets are volatile. You can cherry pick the value. You can average into businesses like the ones we've mentioned today, whether it's Air Products and Chemicals, Nike, PepsiCo, Starbucks, US Bank Corp, any of these companies, Google for that matter, General Mills, CVS, Merck, whatever it may be, Bristol Myers over in the pharmaceutical space. That's what I would do if I just had 100K sitting around and I was getting close to retirement. I would try to put it to work as quickly as possible, but with some caution, making sure I'm not lump summing or overpaying for any individual stock. And then utilizing ETFs as an instant diversification. Yes, Adam, I do sell covered calls for sure. I sold one recently on Merck, and then the stock went down, and so I kept that premium and my shares of Merck. And then I also sell puts quite frequently when I see enough volatility to drive up the premium, which was the case with Nike. I sold multiple put options on Nike in the last 3 weeks and did very well on that, and never was assigned the shares, but of course I get to keep that premium for selling those contracts. Yeah, Adam, that's a good point. If you are getting close to retirement or you're in retirement, you need to be more risk averse. You need to be careful. You can't, if you've still got 10 years of working, you still don't want to lose money. Warren Buffett says, rule number 1, don't lose money. Rule number 2, never forget rule number 1. But if you lose money and you still have 10 years or 15 years of your working career, you can probably recover from it to a certain degree. If you're in retirement and you have PLOC, which is what I call it, PLOC is permanent loss of capital, there's really no easy way to recover from that. So you gotta be careful. You have to know what you're buying. You have to make sure you're buying companies with good balance sheets. Yeah, no, I mean, holding gold and silver is fine. It's done really well for a lot of people. Just because I don't own gold or silver long term doesn't mean I don't see the value in it. And I think having a 2 to 5% allocation has been a really wise choice for a lot of investors out there. And I think licensed financial advisors would probably echo that sentiment. All right, guys, we're right at 1 hour. The time has flown by. Really appreciate everyone stopping in. If you found value in this, just smash the like button. That's all I ask. I would love for this to reach as many people looking for early retirement, financial independence, retire early. I want this to reach as many people as possible and help as many people as possible. Once again, guys, this is not financial advice. I'm not a licensed financial advisor. I'm just a guy on YouTube sharing my journey and how I got here and my personal strategy. I'm in no way telling you to go out and mimic exactly what I did, but I think there's some value here, guys, of all of us sharing our journey. That's more the point. So Howard, you shared your ETF story. We've had, yeah, Richard, exactly. Time for volleyball, let's go. First, I gotta go get my juices. I gotta hydrate. I was at the cenote jumping off cliffs yesterday all day and doing a lot of swimming. And I actually had some cramps. I'm getting older, but that doesn't stop me. Yeah, I just need to go get some good fresh juices, some green juices. Adam, I know you love volleyball. Do you know where volleyball was invented? That's a damn good question. I don't know, Adam. Do you know? Please do enlighten me. Mark and Heather, awesome. Good to see you guys. Yeah. Yeah, it's my pleasure, guys. I really appreciate you stopping in, Mark and Heather. It's a lot of fun to share and support each other in this journey. And just because I'm in retirement doesn't mean that I'm done growing. I still want to learn. I still want to get better. I still want to produce ever more income and cash flow so that I can have a fat fire, the big financial independence, retire early. Retirement's not a lot of fun if you don't have disposable income to go out and play and take trips to Cozumel or Holbox or wherever it may be, or go on dates, or like last night we went bowling. We went to a cenote, had a birthday party at a cenote. All of that stuff costs money, and luckily I'm able to afford that kind of lifestyle. But it's only because I continue to grow and learn, and I've gotten better at utilizing things like options, as you mentioned, Adam. What's up, Colt West? Good to see you, man. Good to meet you the other day on 5th Ave in person. Salud, my dude. That's what it's all about, helping each other and enjoying life as we grow ourselves. Indeed. So I'll leave it right there, guys. Thank you again. Really appreciate all of you. Hopefully you got some serious value out of this. The plan is to do this once a week, and things are ever changing in the market. Things are changing with some of these companies, the political situation, the tariffs. So there's always going to be a new subject to talk about every Monday. And unless I'm out traveling or on some crazy adventure where I don't have cell service or Wi-Fi, I will be committed to bringing you guys these live streams on Mondays so that we can get our money right and hit financial independence and be the owners of our time. All right, guys. See you in the next one. Rope Monster out. Thanks again for stopping in.